So what is your definition of the word intentional?
To me, what intentionality is a constant state of being where you're thinking about the purpose behind what it is that you want.
Welcome to Intentional Growth, a show that teaches you as a business owner and entrepreneur to view and run your company like a financial asset, which will allow you to enjoy work, create wealth, and make an impact. This mindset will help you focus on building a more valuable business and give you the choices to grow, acquire, reinvest, or exit and live the life you plan for, all with intention. And now here's your host, Ryan Tansom.
So, should we reinvest all of our profits each year and pile the profits back into the company to create a more valuable asset? Or should we take the sum or all of the cash out of the company and solve for annual cash flow? Again, like we said in the last episode, there's no right or wrong answer. It all depends on what are you solving for and what do you want. So we are in episode 2 of theme 2, and the theme is, are you creating a lifestyle business or creating a more valuable asset? Last episode, I talked to my business partner, Pat. We gave a lot of context and a lot of concepts on how to think about your company as an asset. And then today, I have a special guest on. His name is Nasser, and he is the author of The Business Owner's Dilemma. And it is a fantastic book that just launched. And Ali is the perfect person to be talking about this concept in more granular detail because of his background as a wealth manager of AltruVista. And so a little bit of background on Ali is he's an Amazon bestseller and a passionate entrepreneur, communicator, and life enthusiast. His goal is to help business owners find their best path forward. And while serving as a guide and partner to some of the world's most successful entrepreneurs for almost 2 decades, Ali identified 3 critical dilemmas challenging their minds. And he has successfully turned those challenges into opportunities via the wealth integrated system for entrepreneurs, which he's coined as WISE, and put those into his book, The Business Owner's Dilemma. And we're going to be unpacking some of these concepts today, specifically the 3 dilemmas, which is the reinvestment dilemma, like I just mentioned, the legacy dilemma, and the exit dilemma. And we're going to be tying these into the 5 intentional growth principles to help you give context. So as you're thinking about your business and what you want long term and really trying to answer the question is, how much should I reinvest and how much should I take out? We're going to wrap that together in the 5 principles and then Ali's concepts from his book, The Business Owner's Dilemma, to give you some more material to help you make more intelligent decisions and more intentional decisions to get you closer to building the life and the wealth that you want so you can create wealth, enjoy work, and make an impact. If you've not checked out the Intentional Growth Financial Assessment yet, go to arcona.io or check out the show notes. It's 22 questions. You don't need your financials. And on the end, essentially what it's doing is assessing how you have your business's financials organized in order to see your company as an asset. And on the results page where you get a score for an overall score and 4 sub-scores, there's 5 videos where Pat and I walk through a case study of what good looks like so you can truly see that end result of what can be possible and then how to actually see your company as an asset from the financials. So thank you so much for tuning in to this episode, and I really hope you enjoy my interview with Ali.
This episode is brought to you by Arcona's Fractional CFO Services. Arcona's fractional CFOs integrate into your management team and assume the responsibility of the CFO. They become your strategic financial partner to help you run the business, create your value growth plan, and build the financial roadmap to the valuation you want to achieve.
Ali, we're doing this.
I'm excited. It's been a long time coming.
I feel like we're 2 friends here, and this is not like I'm jumping on with some random guy talking about things that I haven't heard of. I have so much enjoyed getting to know you over the last, was it been a year or so, I think? And
maybe almost 2.
Yeah, it's so many dots connected from our just our past where we're spending a lot of time. And you know, I mentioned this a little bit in the intro, but I have met so many wealth managers, and like so many times I'm just gonna wrap it into this big bucket of they don't get it. It's like very, very complicated to own a business, own illiquid assets, and like really truly build a comprehensive plan. Met you and I was like, oh my God, I think Ali actually gets it. Lots of experience together. We got some shared clients. So one will be on the podcast next interview. But why don't you just give us a flyby of what you're doing now? You've got a couple different businesses. You've recently published a book kind of give us the flyby, and then we're going to be able to unpack a bunch of the concepts that you've outlined in your book in a little bit more detail for everybody.
Sure. Well, it's a pleasure to be doing this interview, and it's been great getting to know you as well the past couple of years. And I feel the same way about you and your business. I think that there's this natural fit, and we both work with owners, but kind of two sides of the same coin in a way.
Mm-hmm.
One on the business value, one on the personal value for the business owner. So my skinny background is I've been in the wealth services industry for almost 2 decades. I think it's 18 or 19 years now. When I got in the industry, I loved the consulting and the helping people, but I was really disappointed with the product focus, let me sell you something approach to financial guidance or financial advice. Mm-hmm. So I wanted to leave the industry. Instead, the entrepreneurial itch hit me and said, why not just create the business that you wish existed? And that was the birth and the vision for Wealth with Purpose and for AltruVista, and creating a purpose-built wealth planning firm for entrepreneurs, where we could take into consideration not just money management, but comprehensive business, wealth, personal, estate, comprehensive integrated planning. And then also bring their team of advisors, tax, legal, together to the same table so that we're all pulling in the same direction. And for most business owners, that's just not something that's easily available. And getting that with a clear process and a clear path, specifically built for owners, isn't something that was available. So that was the birth of AltruVista. About 7 to 10 years ago, I had a few engagements with business owners that had sold their company, and large exits, 20 million, 50 million, 100 million, even almost $500 million for one of the largest ones. And I saw how much business owners were struggling post the exit. And I'm looking at them going, you've worked a lifetime to create independence. You have all the financial resources, but many of these business owners are really struggling with the life after, their identity, purpose, the dilemmas of then planning and managing the success and starting their next deal or figuring out what's next. And through that process and through the exposure of working with those owners, I realized the value inside of the planning system that we had and the mindset system and basically the approach we had towards entrepreneurial wealth. So you asked about the book. The reason for writing The Business Owner's Dilemma is I saw what owners went through, and having worked with them for years and being a business owner myself and having a lot of those dilemmas myself, it's kind of like a mirror conversation. I took everything, all the experiences, and put it into one book to say, here's the entrepreneurial journey with a new lens. And The Business Owner's Dilemma, well, I'm sure we'll cover some of it today, but it covers the 3 critical dilemmas that all successful business owners are facing, and then brings those dilemmas together within the 6 components of the wealth integration system for entrepreneurs, which is kind of like an EOS for a business owner's personal wealth. So full circle, that's how it all came to be. There's AltruVista, the boutique planning firm, and then there's Wise Global, which is an education and coaching company for successful entrepreneurs, kind of to free of any type of other services.
I love it, Ali, and it's so genuine and it's so thought through, and it's real because you can tell you've experienced it because it's actionable and it's not fluff. And you and I have talked. We've done a bunch of presentations together over the last couple of years, and like for the listeners, and I don't know how many people have been listening for how long, but like I mean. When you and I first started talking, like I went after selling the business and then ended up doing some wealth management in the fiduciary RIA space. And I was like, hey, oh my God, like what if everybody treated their business like an asset? It's like this concept. And what happened is like you and I both are exit planning certified. And, I think some of the things that you're doing and that we've been doing together is interesting, that it's by the time you liquidate, it's too late to move the needle on the business. You now have this wealth that you can plan around it, and we're going to unpack some of these things. But what I found unique about you and AltruVista and your methodology is that, like, how do we think about the business as an asset? And you understand illiquidity, and we're going to talk about the different kind of risk profiles, and which I really enjoyed. I laugh because we all like we'll just roll the dice. Like, well, okay, but as we grow and as we have other things, how can we divest and like diversify in a way that makes sense? That just not just some balanced ETF pie chart and fidelity, right? Like, okay, like there's a lot of complexity around this. But then what also was extremely different about you and your firms is that you care about how they care about their life. So if you like what we've already covered in this in these series of the podcast is your principles, your drivers, and principle one, like what do you want from life, which you address in the Wealth on Purpose, and we're going to unpack, and then how do you grow to accomplish those things. So I just had to say that because it's just waiting for the big liquidity at the event at the end does no justice to anybody, and you guys have completely gone around that and said that you also agree that that's not okay, and that's why you're here. And I just wanted to lay that out there and then say, okay, now how do we handle this? And then with principle two, we talk about principle, or the first financial target is your annual income. What do you need for life, regardless of whether you have the business or not? The second one is your wealth outside the business. And like, how does that, as that grows, how does that impact your choices? And then there's the business. We've already covered the business. We've got more series coming up, so we're not going to talk a bunch about the value of the business right now, but you're going to be able to round this out. Like you said, it's the other side of the coin. So let's talk about, you've got a couple concepts that are going to, now that we've kind of got those three financial targets, you've got some concepts to help us think about the rest of the business and how it fits into people's personal lives. So how do you want to start?
Yeah, I appreciate that. I think the best starting point is where the business owner is, which I think surrounds around the three dilemmas. So I can start by explaining.
Yeah, let's do
that. Okay, cool. So in working with business owners almost 20 years now, I've found that 90% of their thoughts, as it relates to planning their life's wealth, their life's work, 90% of their thoughts surround three dilemmas. The first dilemma is what I call the reinvestment dilemma. So I've been successful in my company. I'm making profits. What's my best reinvestment strategy? Do I put it back in the business? Do I put it in some other business that I start? Do I put it in private equity, in real estate, in the stock market, in bonds, in cash, nowadays in crypto? Where is the best place for me to reinvest my capital? That's the first major dilemma. The second dilemma is one with a little more purpose and a little more depth to it, and that's called the legacy dilemma. And that's, what is it all for? If I have more wealth than I may need, is this for my children? Is this for charity? Is this for fun? Is this for my ego? Will my wealth be a source of empowerment for my family, or will my wealth be a source of entitlement for my family? And kind of this deeper purpose behind, why am I doing all of this? It's the legacy dilemma, which is the heavy one. So lots to unpack.
Yep.
And depending on where you are in life, a whole lot to unpack. And then the third dilemma is the exit dilemma. And the exit dilemma is, should I reinvest back in the business and grow it, or should I sell it? If I sell it, do I sell it to my management team? Do I sell it to a third-party buyer? Do I leave it to my son or daughter as part of my estate and legacy to my family? If I sell the company, does that mean now I have the freedom to pursue my purpose? Or did I just sell my life's purpose?
Mm-hmm.
And these are all questions surrounding in the business owner's head around the exit dilemma. So I found between these three, the reinvestment, the legacy, and the exit, there's a lot of mental chatter.
Mm-hmm.
And kind of in the book, like the opening tagline is take control of the mental chatter, because so much surrounds these three topics for the owners. And many times it's really hard to address these dilemmas because it's both a life decision as well as a wealth decision.
I love it, man. I just like, it's just, like what you just laid out too is it ties with the first three principles. What do you want from your business? Personal drivers. Second one is your financial targets and understand the value of the business, and the three we just covered. And the third one is your exit options. It's like, once you then understand these things, then it's just going and executing. Cause like principle four is just grow value, right? Then you're just kind of like executing the wealth plan and the investment plan that you've determined. And just connecting a couple dots before we continue to go into your framework is that, we talk a lot about solving for annual income as like a lifestyle business, where it's just like they're sucking as much cash out of the company as they can, distributions, perks, salary, and not thinking of the business as an asset. Or they do think the business is an asset, but people are just completely out of left field with how much they think it's worth, versus saying, okay, I actually have a plan, like you said, of like, now if you think about like, if people are handling both sides of the coin, it's like, okay, here's what I want for the business and everything in my life and what I want is connecting both the business and my life. Then how do I actually want to deal with the money that's coming out of the company? And it just goes right into your reinvestment dilemma. It's just super fantastic, man. So like, what are some of the, how did you land on those three? Like what were some of the challenges you were seeing with your clients or yourself? Why was this such a hard topic for people?
So I'll answer both. I'll start with why it's so hard. It's so hard because we think of money as mechanical or financial, and it's really not, especially not entrepreneurial wealth. It's extremely emotional. And sometimes people think spreadsheets, finance, that's what money's about. And I think you'd probably agree with me. There's more emotional management of the planning process than there might be actual direct financial management. I mean, emotional management is huge when someone's going through an exit or figuring out their purpose. So one part of it is it's only natural to stall when you feel like there's two major driving factors. Do I leave this to my kids and keep this as a family asset, or do I monetize it at the highest value when the market's in it? It's not it's always about. So that's what makes it really challenging. How I came up with the three dilemmas is at one point when I was taking our Wealth with Purpose process, which is the supporting planning process for us, and I was organizing that into a higher level system and taking years and years of work and kind of putting a framework around it. I just created a whiteboard one day, and Ryan, no one's ever asked me this question. I'm really glad that you have, and I'm thinking about it really for the first time. I whiteboarded everything I could possibly think of that was on the minds of business owners. Like, what are all the questions where they are, not where I feel like they need to look at, or where they're tax or legal or financial, where they are, the questions on their mind. And I put all of them on a whiteboard, and I started to look for themes. And this is where I found that, like, okay, there's an 80-20 rule. 80% of this stuff, actually more than 80% of it, tied to these three categories. And I just labeled the categories based on what made sense, and that turned into the three dilemmas. So it happens.
It's such a hard process, and it's exactly kind of how we went through with the 5 principles. It's like it's hard to distill down to the truth. I mean, it really, because like it's I don't know, and we don't have to go too much down this rabbit hole, but it's like what's that one comment? It's like, I don't have enough time to write you a short email. It's like the whole, like, I'm going to distill. It takes time to distill it down to the truth of the principles, which I think that is why you're here. You've got this book, and I completely, it just makes sense when you look at it, self-evident. And so, like, now let's talk about, like, okay, so when you think about like as a business owner, the biggest question that and again, how we tie this into some of the other parts of the framework that you have is, if I've got some clarity finally, it's like, okay, let's say hypothetically we got $1 million in cash flow EBITDA coming through. What am I supposed to do with this? Like, how do we start to, like, break down the framework to decide on what I want to do with that money? Because I think a lot of people, it's like, I don't know, man, like, I get an extra $500,000 out of the company. I can hire VP of sales. I could do a marketing plan, and I should get, a 30% rate of return. And do I just keep doing that forever? Or do I just suck every dollar amount, and I'm always competing with my, VP of sales with my boat or my wealth manager or my real estate hobbies? So you're now we're in your territory. Like, how do you navigate that conversation with people?
Oof. Yeah, that's lots of questions in one. So let's start at the top, and then I'll break down the actual modeling, and I'll screen share how that actual diagram looks. But it starts really at the top with what you want. You've got to make a decision as to whether your company is a lifestyle business, where it's the boat, it's the lifestyle, it's the fun, it's all about what it is that it does for me, not necessarily about maximizing the enterprise value or the business value for the company. So that's the first thing. You want a lifestyle business, or are you truly trying to build something that has marketability, that has equity, that can grow that total enterprise value? And that is, if more business owners made that decision on the front end, it would make the next 500 decisions so much easier.
It's like, I've related when people don't make that decision. I'm like, you're like stuck in purgatory. Or okay, there's too good not to repeat it.
Intense, but yeah, I hear you.
Yeah, it's like, and then another great one I was from a guy yesterday I was talking to and he goes, man, I feel like I'm sitting in a hallway. I have 2 doors open, and I've been stuck in the hallway for like 5 years, and I don't know which door to go through. I'm like, oh my God, I love it.
Yeah. And and you all of a sudden you feel like you're overcommitted to different paths. And there's this saying that people that are overcommitted, it's because they lack commitment.
Mm-hmm.
Because if you're committed to this is a lifestyle business, that's what it is, or you're committed to I'm growing this as enterprise value, now all of a sudden your set of choices goes from 500 things to 10. You can really focus on what really matches. So that's the first decision. What do you want? And there's no reason you can't have a hybrid to say, I want to build enterprise value, but I want a certain amount of cash flow. And this is the dividend stream I want to create for my lifestyle. You're not paying the boat out of the company per se, but you've got that. So there can be a hybrid. So it starts with what do you want? And then once you know what you want, you've got to look at your desires for reinvestment. How much capital is going back in the business? And then your unique desire for risk, like how much are you comfortable having in one microcap stock versus having elsewhere? And some business owners, especially when they're starting out, I'll be all in the company 100%, no worries. And then it may be later on in life, they go, you know what? I don't have the same energy I did when I was 35, 55 or 60 now. I would like some restart capital if things didn't work out. And I'm reassessing how many chips I want on the table versus off the table. So I'll introduce a diagram that kind of explains how this works. And then I want to go into your example on you describing, well, I could hire a VP of sales and get a 30% return. How does that work? So,
and as you're pulling that up too, I think you introduced a topic that's very consistent with some of the things that we talk about, which is you can do both. So like on that $1 million, let's say if you're in Minnesota, you're paying like 350 grand in taxes. But if you're in Texas, you're paying a little bit more, less, right?
Yeah.
But my point is like, let's say you hypothetically said, okay, we're going to reinvest $500,000 back into the company. The only thing I would add to that is like, and you probably deal with this, Ali, is like you probably sit down with a financial plan with someone like, hey, we're going to expect $500,000. Or let's say in that example, you expect $250,000 to reinvest into your world of other things. So many times I see the idea visionary entrepreneur that committed to this big vision and didn't realize that $500,000 to fund that vision a year is not enough. So then you don't get that $250,000 that you, Ali, said you needed for their plan. So I think the only thing I would add is make sure that if you identify that you need the cash flow, make sure that is whatever you're reinvesting is sufficient to hit the growth targets of the company. Because otherwise you're going to be sitting there going, where are the distributions, Ryan? You're like, I hired those people.
Yeah. And that's really why it starts with what do you want from the company? Because what you never want to do is handicap the business because you had a personal savings goal that needed to come out of the company. If the business needs the capital, you want to be intentional about growing the business and have the funds ready to do that. And again, you got to call your priority. It might be that a business owner and their spouse may say, hey, it's critical that we have a path to financial independence separate from the company, and we have to save X dollars each year to hit that target. Then that may be the priority. But you've really got to start with what it is you want most and prioritize from there. And I think this diagram will help explain some of that. So,
and for the people listening in too, we'll be talking over it too, so that way if you don't have to be seeing it.
Yeah. So it starts here with how entrepreneurs think. So what I'm about to explain to you in this diagram, it's called the Entrepreneur's Investment Opportunity Diagram. Kind of a mouthful, so I call it the IOD. So this IOD, it explains how every entrepreneur thinks about investing, but not necessarily how we always articulate it. This is what goes on in our head when you put it to paper. The first thing is most business owners say, hey, my best investment's my business. And that's
well, but just I'm going to pause you for a second, Ali. So for the listeners on the left side, we've got a bar graph and there's an arrow going up on the bar and an arrow going down. So there's a line left to right and then arrow up and arrow down. And on the left side, it's potential. So potential upside or potential downside. And then you've got a bar, the first bar on this bar chart.
Yeah. Okay, cool. And if you like, I'll verbally explain things for the
audience. No, that'd be good, because then we got a lot of listeners, but we now know that we got the YouTube, so not everybody's defaulting to the YouTube.
Yeah. And candidly, I listen to your podcast in the car when I'm listening to them, so I'll do that.
And I'm not Joe Rogan, so I can't get a video on Spotify yet. So apparently, you have to sell your company for a bunch of money to do that.
Wow.
Sorry, I digress.
Maybe one day. So basically the first thing that a business owner can or wants to invest in is their own company. That's where we can generate the highest potential return. That's where we have a competitive advantage. I often hear owners say, I don't invest anywhere else because my business is my best investment. That's totally the way that it works. And if you've got a successful company, it's going to be extremely hard to find a better return than your own business. That's just the nature of you building something yourself. Then after that, you've got some alternatives. And those alternatives are, you could invest in private equity, you could invest in public equity or the stock market, you could invest in real estate, you could invest in fixed income or bonds, or you can park money in cash. And for those that can't see the diagram, each one of these has a slightly lower rate of return as you go down the list from your business, all the way down to cash, where essentially your return over the long term is typically more like inflation, if that. And then there's this other asset class, which I can't do a podcast interview anymore without mentioning crypto, because it always comes up. But now some people also think about crypto as kind of this digital asset class, which is another asset class, which I don't put on the diagram because it's too new and speculative to actually measure what the fundamentals are. But it is definitely something that exists and is real in the marketplace. Then each one of these asset classes has a corresponding level of downside risk. And the largest amount of risk, if you're looking at the bar chart, is in your business. You get hit by a bus tomorrow, there's a big lawsuit, disruptor comes along. If you're the Blockbuster and someone else is the Netflix, any one business can go down. And then followed by, if you have a diversified portfolio of private equity versus public equity versus real estate, fixed income, there's a declining scale of risk. Mm-hmm. So when you look at this, or you look at this diagram, you see that essentially you're going to get rewarded for upside. You also could get penalized with downside risk. Mm-hmm. And the reason entrepreneurs are so comfortable investing an enormous amount of their net worth in one company, it boils down to one word, and that word is control.
Right? I wasn't going to start. I didn't even know what you were going to say. Like, I'm not going to steal his thunder, because yes, 100% control.
Yeah, right. And the example I give is that if somebody had $50 million of net worth and it was entirely invested in Apple stock, what would you say to him, Ryan?
That's pretty dumb.
That's pretty dumb, right? Crazy. You should diversify. That's well. But what if someone has 50 million of total net worth and it's entirely invested in their company?
No, I know. We immediately you almost sound like a hypocrite saying it. That's pretty dumb. It's what you say. Yeah.
So, you hear someone with a $50 million company, like, wow, congrats. What an accomplishment. Like, what are you doing next? Are you scaling? Are you growing it? But you're not looking at that business with the same lens that you look at Apple. But the reality is 50 million in Apple probably has lower risk than 50 million in a small business.
Isn't that crazy? Well, because of how big Apple is. And it's so fascinating. A couple of comments on that, Ali, is that one is growth is expensive, so you can't get away with that. A lot of companies aren't funded the right way because their financials aren't built the right way. So a lot of them end up, self-financing all this because they don't have the clarity on that. So it's like growth is expensive. They hold on to this rocket ship, and I literally talked to a guy last week, and he's going to probably know he listens now. And he's like, I just took the first distribution in 20 years.
Wow.
And it's like, well, because he grew so darn fast. And so that doesn't mean, just because you're growing fast doesn't mean that you can't do what you're doing, is I guess my point. I mean, and there was another, I don't know if you and I talked about this story when we chatted in one of our previous sessions, but there was an analogy that someone gave me, Ali, that if you think about a gymnast on the balance beam, mm-hmm. and if that gymnast does all those crazy routines in the Olympics and then lands it, they land it 98% of the time. I would never land it. So it's their level of expertise and control allows them to land something that's extremely hard for everybody else 98% of the time. But if that person breaks their ankle, they can't do it ever. Yeah. So it was an interesting way for me. That's a great
analogy. That's a great analogy. Because that is the case with so many owners, is that their land, they may control it just right 98% of the time, or 90% of the time, whatever it is. And it's those crucial moments where a critical thing happens. And we saw that with some hospitality businesses and COVID. Literally, mm-hmm. I remember one company was $8 or $9 million of revenue to zero in 60 mm-hmm. days, mm-hmm. or 30 days, really. But anyways, I digress a little. Totally love that analogy of the gymnast. But
the control, I was just validating it in just a long-winded way of the control is a real thing, but that doesn't mean. But I don't think people understand the risks that they're holding with that.
Right. And that's where, so that the psychology that kicks in here is when we have a high degree of control, our perception of risk goes down. And when we have a low level of control, our perception of risk goes up. And this is specific to entrepreneurs. This is the way that we think. So when we look at, the stock market, low level of control, that perception of risk is really high. And I meet these guys who have $50 million in their small business stock in the oil and gas industry, which is like the wildest ride, going, I don't invest in the stock market. That's too risky.
Really?
It's perception, right?
Yeah,
and then
right.
you see the opposite situation where, because they have control, all of a sudden anything's on the table with business risk. So the key thing is perceived risk. And if an entrepreneur knows, and the best way to answer this, I mean, this is the eye opener, and I get people that kind of pop their eyes open when I say this at a conference. You've got $50 million in your oil and gas business. Imagine taking $50 million and investing it in somebody else's business. And they kind of
they do exactly what I did.
No way. Even if it's in the same industry, even if it's one of your competitors,
100%.
You're not going to put $50 million in someone. It's because of your perception of risk, because of your control. So that's the first thing an entrepreneur has to be aware of. And when they're looking at this diagram, what I explain is you may only see the downside in your business as a tiny bit of red. And for those that aren't on the screen, there's a big red downside in your business. But there's a lot more than you might see. And it's totally fine to be fully invested in your company and take that risk. I'm not saying not to do it. I'm just saying eyes wide open, because as you hit different levels of success, if your eyes are wide open and you have perspective, you can make better decisions. And there may be a point where you say, you know what? I've made a lot of money in my company. I've been really successful. It might make sense to take some chips off the table. And maybe not all the chips, maybe just enough that I have financial independence, maybe just enough that I can get a path to there. And maybe I need to diversify some of my balance sheet into other areas. And this diagram helps see what other opportunities you have. So your example you gave, we talked about real estate and reinvesting back in the business. I want to share a quick story here. I had a business owner, and I think in the book, his name is Alex, right? Alex came to me. This is back in 2015. True story, just not, his actual name isn't really Alex. He came to me, he said, Ali, I want to invest in real estate. Why are we paying rent? And in 2015, the real estate market in Houston was getting pretty hot. It was kind of high oil prices, things were expanding. He said, I want to buy a piece of real estate and have our offices on the real estate. I'll do the deal. And I said, well, it depends. And we kind of referenced this diagram. I said, what is your rate of return, your expected rate of return on real estate? And the broker that he worked with, it kind of built out the investor partner. And he was saying, I'm expecting about a 15% internal rate of return. So what's your rate of return on reinvesting back in your company? And he had a consulting business, and he had enough clarity on his financials and business. He knew, well, reinvesting back in his company. We had to have some conversations with the CFO to get there, but I'll make that short. 30 to 40% return reinvesting back in his company. So I'm saying real estate may be a great investment, but compared to what you're getting in your business right now, it's 15 versus 30 to 40. And 15% is in a new business that you don't know. You'd have to hire a property management company or do it yourself. You're now a real estate owner. It's a new thing. What's your preference? There's maybe lower risk at a lower return. And just hearing the numbers and hearing the position, he immediately went towards, oh no, I'm putting it back in the business. I'll stomach. I needed an excuse to stomach the extra rent and not have to think about that, because really the business returns better now that I see it. I want to put it back there. And the higher revenue that creates higher earnings also adds to the multiple of my business, so that it's worth more if I ever sell it. So he got that. The thing is, most business owners, and this ties into what you do, most business owners do not know the rate of return on reinvesting back in their own company.
Right. They're no context for that conversation.
Yeah. What's the ROI? And when you look at this diagram, you can't tell whether, I've met some owners who think their business is their best investment, and their reinvested capital that goes back in the business makes an 8% return. So they're taking a lot of risk to make 8, but they can take a whole lot less risk and potentially make 8 elsewhere. And then other owners that have a 50 or 70% return in their company and aren't funding the company the way they need to because they keep pulling capital out. So the key thing to this diagram is know your options, know the risk, and know the return of each one of these asset classes, so that you can make an educated decision on where to put the capital, and then also factor into it, how does this reinvestment affect my desires for risk and my life goals? Because it's not all about the highest return all the time. Sometimes it's I want some diversification.
Well, and let's go back to where we started, which is what the hell do you want? like if you don't know if you want a lifestyle business to pull the cash out or to grow a company with a specific strategic plan, how do you even start having this conversation with someone like you when you don't know that? And like, even let's say like someone knew all that stuff and they had the clarity of like even that story you just told. I just want to challenge some people on how they think about this stuff is like, so you could know all of that and say, okay, yeah, maybe there is a 30% rate of return in my business, but what's the business risk? Like, is there like a market that's declining or whatever it might be? Because you could like, you and I probably have both met people where it's like, dude, your business is just risky. Like the industry might be going like down or whatever it is. So yes, you have been traditionally getting 30% rate of return, but if you look at your business like an investor and going, should I hold my capital in this asset? Then you're having more of that. You're being honest to yourself is all that's all you're doing.
You're seeing it with the right clear lens. I think when you have the right, it's like the glasses, right? You got the right glasses on, and then you can make better decisions. And that's really the whole purpose behind, everything in the book, everything in our content, everything we do is give business owners better perspective so that they can make better decisions. Because owners rarely need someone else to make their decision. They'll make it the decision, but sometimes they're missing the input.
I just need a little bit more data than my gut. And so before we continue, because we got some of the other parts of the book and the components that we can dive into, I just wanted to acknowledge that like what you just discussed is so unusual for a wealth manager. Because from my perspective, and I just wanted to hear your thoughts on this, 99 point, maybe there, I mean, I would assume it's to the right of the decimal point of advisors that are in the wealth management are going diversified ETF portfolio. And, JP Morgan gives me my 6 different portfolios, 60-40, whatever the hell it is. And I get my 1% on top of that, maybe some additional products, and we're good. They don't address some of them. Maybe a good chunk might understand investing in real estate or private equity or something like that. But they choose to not have a holistic discussion around it because they get paid off of the liquid assets. So like there's kind of maybe 2 parts to that, Ali, that I'm looking for some thoughts on. Is one is like understanding them is one thing, which I don't think a lot of people understand, but I think there's definitely the people that do. And then there's the incentive is not to talk about it. So essentially all the stuff you just talked about is not usually discussed in any way of matured discussion where you just helped your client divert cash away from things that you could help with back into their business. So I don't know, if any kind of comments or thoughts on that in general.
There's so many. I could probably do a keynote address.
Yeah, a whole day on like the industry in general, right?
Yeah. So the first part is where their conflicts lie and what they're trained to do. So most of us are a product of our training. So if you had an entrepreneurial life, you're a product of whatever exposure you had in whatever way. It's very diverse. If you're a product of the medical industry and you go to med school, you're trained to learn this. If you're a product of accounting, you're trained to learn this. Well, the financial services industry, the main big JP Morgan's, Fidelity's, you come in, training program is asset allocation. How do I take your money and put it in a portfolio and then show you, here's the cash flow that could come off of it. Here's how much you need to retire. These are the dividends. This is the risk. Those are your parameters. Wash, rinse, repeat. See as many customers as you can. And your compensation is going to be based on how many customers you put in or in the quantity of those quantity of those deposits. That's what their incentives are based on. That's what their planning education is surrounded around. Essentially, that's what they do. It takes a certain personality, and I'm certainly not alone in the industry, but it is a fraction of a percent that goes, wait a second, there's more to this equation than just investments in the market. And what else could really benefit the best needs or the best interest of the client? And then it goes a layer further to say, well, what if you have an entrepreneur as a client and you're looking at them going, wait a second, there's an even greater opportunity set. We went from we went from stocks, bonds, cash to stocks, bonds, cash, private equity, real estate, and your own company. So now there's a whole set of things. And how do we do the right thing, but also support what planning goals need to happen? And that's where I kind of looked at it just as pragmatically as I could. As an entrepreneur, serving entrepreneurs, going, how would I think about this? Would I put money in the market if I could make a much better return in my own business and I had the appetite for it? No. Well, how do we combine the two? Because at some point, people need diversification. At some point, it's not all in your business. If Elon Musk tomorrow, it depends on the day.
I was going to say
he's probably $100 billion gyration in the past 2 months. But let's just say we're talking about a guy who's worth, I'm just going to use 150 billion, right? The guy's worth 150 billion and he knows Tesla and loves Tesla and that's his company. Great. Is there any harm in the world? I'm not saying take 100 billion off the table. To say, Elon, your craziest lifestyle that you could imagine living, how much does that cost? And maybe we need to take $2 billion. Assuming your lifestyle is just crazy, but $2 billion of your 150, put it on the side and say, here's independent wealth capital. That if Tesla ever vaporized, and 2 years ago there was a concern of bankruptcy, right, when they were a much smaller company, you've got this $2 billion off to the side that's protected, that can create lifetime cash flow, everything you need. And then the 148 billion, if you want to go to the moon with it, go to the moon with it.
To the moon. Sorry, I distracted you.
No, so I just pictured you. So it's really about the pragmatic approach to it, thinking about it as an entrepreneur. And then from there, I think also from a compensation standpoint, we have a planning process that we charge a fee for each year that brings all these pieces together in a blueprint and shows a business owner, here are the components you need to consider, here are the numbers you need to. So there's tangible, deliverable work product and experience and process that all surrounds around planning. And you go through all of that and you're like, how much of that process was talking about my asset allocation in my portfolio? Maybe 5% of the time, 10% of the time. You can't, our competitors or other firms, they can't do the level of planning that we're doing unless they're doing a separate type of engagement and have a whole level of training for their teams around these topics. So basically what most will say, oh, we just want to manage your money and for free we'll give you planning guidance. And that's really not true planning. That's just, cash flow spreadsheets or something. It's not really planning.
Well, and I wanted to call that out because there's truth to what you're saying and it should be listened to, and it's not just made up from someone that's got the wrong incentives. Like that, hey, I should be saying this stuff, but it's just like lip service. It's not lip service, which is why we're going to get into then some more of the components on how do people think about this? So you go through the risk tolerance, something, what are the next steps? And I know you've got, is it 6 components? Is that what it is?
Oh, within WISE?
And maybe I'm jumping ahead. I'm kind of looking at my notes for the listeners that are wondering why we're, there's a lot to this.
I'll explain
right
each one. So everything within the spectrum of entrepreneurial wealth fits into one of 6 categories. And this is taken from the system that I introduced in the book, which the nickname for it is WISE, but it stands for the Wealth Integration System for Entrepreneurs. And that's where all the pieces come together. So there's 6 components. The first is called balance sheet strategy, which rather than just thinking about your investment or your business strategy, it's the total balance sheet. How are all the assets working together towards a strategic goal? The second component is liquidity and cash flow. How much liquidity do you need to have, both business and personal? How much cash flow is coming in and out? How should you position all of this to be the most effective and efficient? The third is lifestyle and legacy. Either money is going to be spent for your lifestyle, or it's going to be excess that is left as your legacy. And there's only 3 places your legacy money can go: family, charity, or the government. If you're really intentional, more can go to family and charity. And if you're not as intentional, more goes to the government.
Yeah, amen.
The fourth component is exit strategy. An exit strategy is both it's if you want to sell your company one day, if you want to build more value inside of your company as you build up towards a sell, or you're looking at succession to your son or daughter, or continuity in the event unexpected comes along. How does the business continue and not just fail? The fifth is asset protection strategy, which is how do you protect everything that you've built? If you get sued tomorrow, how is it protected? If there's a big estate tax liability, how is it protected? And then finally, the sixth and final component is lifetime tax strategy, which is not about April 15th planning, but it's about zooming out and saying not tactical file a return, but zooming out over the 30 or 40 years, the big picture. How am I mitigating the taxes in the most effective way? And on a generational wealth standpoint, how am I keeping more of my gross? And a lot of times owners don't look at that and they focus on gross return and they don't do planning, and their net return is so much lower. And if they did planning, they might make 10 gross and keep 7 versus right now they're making 10 and keeping 5. So all layers of tax. How do you build that lifetime tax strategy? So these 6 components come together, and the keystone, if you will, is your vision. If you have a vision for what it is that you want, for your lifestyle, for your income, for your goals, for these different components like legacy and asset protection, the keystone brings the pieces together. And when you go through all of this and you have clarity on what it is you want, then you can have more levers. Because if I know someone's vision is, you know what, I really want to build this, multi-million-dollar charitable foundation one day. Well, if I know that in advance, I can impact
for it.
When you sell your company, we might have you have paid $3 million less in taxes when you sell because we integrate charitable planning. If I know what's going to be your kids one day, we can do so much generational wealth planning that the IRS doesn't even get to touch it. And there's so much that can be done if you can be clear about your goals. And what I find with most business owners is they haven't had the time or space yet, or the process or the person to help them through planning those goals. They have 5 advisors, tax, legal, financial, investment, but the advisors don't talk. Because they don't talk and they all work in silo, they have segmented planning, which usually has big planning gaps, and it's just waiting for a catalyst to come along. And the catalyst could be selling their company, it could be an increase in income, it could be a lawsuit, and it could be a death. And then they realize the planning gaps and they're going, what happened? How come these issues are happening? And it's because you outgrew your planning model. You're now a multimillionaire business owner and you haven't had integrated planning. It's like having a company with 4 C-suite members that have never met each other.
Yeah, or I would even give it like it's like by default, these people that choose that route, even if it's by just inertia, it's like you're taking the role of the general contractor, whether you like it or not. Like someone's got to the buck stops somewhere, and it's you. I mean, it's you on all these things, and it's not the attorney's just not going to call the CPA, and the CPA is not going to be like, hey, by the way, this is how much we're going to net. And like all of this stuff, there's so many cracks. I mean, I've done webinars for your audience about, hey, by the way, don't do all this after you sell. So we're just proof that this is the right route. So like, as you're going through this, and you and I were talking a little bit about your lifestyle versus you had the tax. If we want to dive into that, because I think so. We're about to introduce the concept as we talk about kind of like lifestyle and solving for the business lifestyle versus some sort of legacy. How do you think through this, and how does it impact your investments?
So what this I'm going to pull up another chart here. So what this connects to is, say someone either they've just made great income, or they've exited their company. And they're now looking at like, how do I position my capital? What is it for? And sometimes estate planning comes into this. Your spouse will certainly have an opinion on these things, impacts your children. But oftentimes this can be so overwhelming. People think about, looking at their estate and life and legacy, and it becomes overwhelming. They think about tax entities and structures. And this will just simplify everything to one diagram with 4 easy boxes. I'll walk through each thing here. So the first thing I want to explain the chart, and especially for those that can't see the visual, this chart connects to 2 groups of your wealth. The wealth that's for your lifestyle and the wealth that's for your legacy, which essentially is the excess of what you're not going to consume for your lifestyle. And in the middle is a dashed line running through the center that's the tax fence. So everything to the right side of the tax fence is tax-free, meaning no estate tax to your children. This isn't about income tax. This is about estate tax. And everything to the left side of the line is taxable. It's within your estate. So that's the two categories. The first thing you've got to identify is how much do you need for independent wealth? So
just 2 billion, like you said, man. Like I that's all. Just like Elon, right? Just take this 2 billion on your 150, and I'll be just fine.
That's all you need, right? Let me see if I've got. All right, this clicked here. Okay, cool. So now you've got this independent wealth capital, which is, if, for example, I'm going to make the numbers really easy. If you needed $400,000 a year of gross income separate from your company, and it was independent wealth capital, and we used a 4% distribution rate, that would mean you need $10 million of principal, and we're distributing 4%. Let's say the remainder of your return is being reinvested for inflation protection. You've got independent wealth with $10 million at $400,000 a year of gross income. I'm not going to factor in taxes. The next thing is, and this is often overlooked, is business owners, especially when they sell, they're going to want a certain amount of capital beyond independent wealth, and that capital is the risk capital or business risk capital. What they want to have fun with. I want to go to Vegas. I want to play with private equity deals. I want to be an angel investor. I want to, participate in upside, but not put the family nest egg at risk. So you want to identify what's that play money, right? That risk capital. Once you've, and depending on the risk aversion between you and your spouse, chances are one of the two spouses is really excited about independent wealth capital, and the other spouse is really excited about business risk.
You just described entrepreneurs and their spouses, regardless of whether it's male or female. I've met the spouse of so many entrepreneurs, and it's like, just let's protect some.
Right.
It's like the person that's at the casino, just like slowly putting chips into their pockets, so that way you don't know that you're playing with them.
Yep, you got it. And you got to have the happy spouse. And so now that you've covered what you need for independent wealth and you've covered what you need for fun, the next thing is to look at what's outside, like what you could potentially have as excess. And the excess is usually for one of two places. It's either for your children or your family or heirs. Primarily, in most cases, it's children. And then there's what might be for charity. And for some business owners, everything in excess of what they need may go to their kids. Some, nope, I'm not gonna give my kids all that wealth. I'm gonna give them a smaller portion or enough that they have what they need, but not what they want. There's every mix. Some leave them nothing. Just depends on your goals. But what do you want to have happen for your children? And then beyond that, what do you want to have happen for social impact, for charity, for community, whatever your calling or your cause may be? And these are the only places it can go other than the government. So if you're really intentional about planning your wealth, it starts with what you need for yourself, what you need for fun, what's excess for your children or excess for charity. And that kind of simplifies the whole equation of, hey, I sold my company for $20 million or $50 million or $2 million, whatever the number is. How do I position my wealth to meet the life goals that I want? And this framework helps kind of put some simple lines around the different categories to give a business owner more clarity.
I love it, Ali. And like when I think about how when we have discussions in our trainings with people as they go through principle 1, 2, and 3. So again, principle 1, what do you want? Principle 2, your financial targets, and then 3, your exit options. We're kind of laying the groundwork to putting context behind the business and the choices that they have to make. And I'm just going to kind of tell a story and how it relates to these 4 buckets. Is like, like when if people can truly view their company as a financial asset, then we're doing. When we go in principle 3, when we talk about exit options, there's 2 different ways. It's the exit and how to monetize your asset, which is different than exiting your role. Because people call me like, I want out. I'm like, out of what? Your job or the financial asset? And like people haven't thought through that most of the time. But if we separate the job and then the asset, then when I think about how people identify their targets after they go through the training and on their vision board, it's like, hey, I need to grow this company to X EBITDA. So it's like, hypothetically, I'll just take a story of, I need to go from 1.1 million in EBITDA and a $5 million valuation to go to 2 million in EBITDA and a $12 million valuation. Because in the first one, the debt taxes, they'd only walk away with $2.5 million. And the second one, if they grew that EBITDA and the enterprise value, they could walk away with 8 million. But then it's like, but what's the exit? So like in an ESOP, you might be able to get, a third to a half of your money up front. The rest is a seller note. Or like in the private equity, you might get, 60%, and then you have to roll the other ones. You layer that choice between those options onto this graph that you got going and say, do you have enough for your independent wealth and your business risk at closing? Don't make sure that you get the earn out in order to get your fund, like, you know what I mean? Like it's a lens to say, okay, how much am I willing to take up front versus roll? And that's another, like, I don't know if that kind of goes into some of the stories that you've got, but people don't have a framework to think about how much,
right?
Because the deal structure is one thing, the valuation is one thing. And then there's the deal structure, net proceeds that all have to be laid on together to then choose between their options.
Yeah, no, you nailed it. I think when you talk about the difference between enterprise value and net proceeds, I remember.
What? There's a difference?
Yeah, I remember one of the first times I met it was an EO business owner. People were talking about, oh yeah, he just sold his company. He got like $35 million for the company, and I was like, oh, okay, interesting. And anyways, long story short, we started chatting, and his net proceeds were just under 10 million.
Say that again. Say that again. Yeah. Say that again for the listeners.
He had a $35 million exit. And everyone was like, oh, such and such sold for $35 million. And when we get to talking and looking at his net proceeds, it was under $10 million, like 9.6 or something. I know. Like that. So, and you're thinking, how in the world does it go from 35 million to, well, he had some 35 million was sold. He had some debt on the company. So he'd pay off the debt. He had equity, a partner that was a smaller, I think it was some 30% or something to that effect, our equity partner in the company. And then he paid out certain team members as part of the deal, kind of bonused out certain team members. And then he had a bit of money that's going to be earned out over the next couple of years, smaller, but nonetheless. His net proceeds from the sale were under $10 million. And they had taxes, of course. Can't forget that. Paying taxes on it. So many times people will say, oh, I've got a $50 million company or a $100 million company. Net proceeds, in your equity
that matters.
Is very different than what that big, that big enterprise value number looks like.
Well, so and then go ahead. Sorry, go ahead.
I was going to say, you plug in the net proceeds, and these buckets that are up on the screen, you can look at, the way we show it is, here's how much your bucket's already filled with your savings, your real estate, whatever assets you've got already. Here's where you are. Your gap, your independent wealth gap is 6 million, and your risk capital gap is 2 million. So we know that the minimum for you to meet your goals with your exit for yourself is 8 net proceeds. But if you've got a $3 million goal for charity, well, now it's 11. And if you want to leave, or if you want to start giving money to your children beyond what their inheritance will be, then we've got even more to fill. And that gives the perspective of like, okay, I get it now. Here are the different buckets that need to get filled. I now know what my net proceeds need to look like. Or I already have my net proceeds, and now I need to dial into how much I can get. And sometimes that might mean, you know what? I thought I was going to live a $500,000 lifestyle. I didn't sell for enough, and I might have to reduce my lifestyle to $300,000. Still a great life, but I'd rather know I need to reduce it now than see over the next 10 years my wealth declining because I'm overspending.
Or it's just like you said, like it's just insights of like, what do you want? Like, do you want to sell right now? What's it worth? And what are your options? How do the options impact what you want and your targets? And then you like when you talked about the two sides of the coin, I mean, it's so perfect because like that person that it was actually kind of an example of like, hey, my company's worth $7 million. That's what my financial advisor told me. So I put it on my personal financial statement as $7 million. And after going through a training, it was like, oh no, it's actually worth 5.5. That tax is 2.5. Like, what the hell? And it's like, okay. And so they shifted their mindset. Like, I'm going to grow this asset, pay off a bunch of debt, grow the EBITDA, grow the multiple, then net $9 million. And like, they're just on their way doing that. But because they've got this framework, but we helped them from the business side, but it's like, well, what do you do with them? I don't know. Is this enough? Like, and again, like, yeah, like you just round out and provide that context for everything we've talked about. Like now you have a more personal, you have a 360-degree view of how this all works to then make the choices, right? Like no one's telling anybody what to do. It's like, here's all the information and how to make your decisions. Like, I don't care what you do. Just don't regret it, whatever it is.
Yeah. And take the time to be intentional. right? Here are your decision points. That's
So,
spot on. Spot
yeah,
on.
man, what is I don't know if there's anything we're missing, man. I just or anything in the one question I wanted to ask you as you kind of maybe noodle on what we if there's additional things we want to cover.
Mhm.
I wanted to have just a brief discussion with you, Ali, about the word exit, because I've been bringing it up a lot on this show, and people have probably different thoughts about what I think about it. But when people hear the word exit, and you and I are both exit planning certified, and like I think they're doing good things. There's value building. There's all these different things out there.
Mhm.
What I see so much is that people they hear that and they hear estate planning, insurance. I'm going to take my head like an ostrich and shove it in the sand because that sucks. I don't want to talk about death, all those other things. So they don't do any of this stuff, and they end up like I tell my story, like after the deal, then I realize all the stuff we're talking about is important. I'm like, oh shit, I wish I would have known that for like 48 months ahead of the deal. So like I see that like exit planning is important. All this stuff we've been talking about is important. Personal wealth planning, the business planning, that understanding your exit options is all important. But that word is just like it's a swear word to business owners. What are your thoughts, and what are your experiences on it?
Specifically on the word exit.
Mm-hmm.
Yeah, I mean, exit. I think there's two perspectives. Some, man, something has already been absorbed in them where they're like, exit planning is a good thing to do, because
Mm-hmm.
I've met some business owners before they've started their company. They're going, here's how we're going to exit the business. Like, we're going to start this and exit it in 5, 10 years.
Mm-hmm.
That's a minority.
Mm-hmm.
The majority of business owners, exit has a few negative connotations. One
Mm-hmm.
is the thought is, I'll never sell my company. I'm not planning to sell my company unless I get this amazing offer. Then anything's for sale. But otherwise, I'm not interested in it. It's a distraction. I've got priorities to handle. Some get terrified when we see an invitation for an exit event, because they're like, man, if my team members or my assistant sees that I'm going to a seminar or a luncheon on exit planning, they're going to think their job security is in danger. Are we selling the company? The third is, I think owners don't understand that, and candidly, this is where education comes in. Don't understand that exit planning, when it's done right, isn't about selling your company. It's about building value in your business so that when you sell, you can sell at the maximum amount. And I don't think that is translated well. Each time I talk on this topic, I have to keep re-explaining. There's value enhancement, and then there's selling of the company. And some of you might be in the situation where you're selling the company. Most of you are in the situation where you're trying to build more value and know the quantitative and qualitative drivers that can change the value of your company and start executing those. So when you sell, you can sell at the highest number. So my experience with you has been similar. I think exit planning oftentimes can put people off. Part of it is any kind of planning for business owners. Sometimes if it's not about their business and what's generating new sales or revenue or profit, a lot of times that's just deprioritized. But in short, to come kind of full circle, it starts with education. So the biggest thing, and I know you have an education program, I have an education program. When we go talk at different events, today's podcast, it's really all about education, right? No one's selling stuff. It's about education. The more we can help business owners see what they don't necessarily have the time or inclination to see, I think they're better off they'll be, and the easier it'll be for us to kind of create a new paradigm for things like exit planning.
Well, well said, man, and I tend to agree with everything you said, and I think that also like firms like yours that make it available to actually do wealth planning, like you're doing wealth planning for a business owner, which is like it's a family office. We are doing advanced tax planning and estate planning, and like so you have wealth planning, and then like hey, you might have some investments in private equity. You have a company, but like private equity firms, they don't call it an exit plan. And like I go buy a company, I grow the value, and I sell it. Like that's the plan. I'm a professional investor, and I think that's what we're trying to promote is like exit planning is like professional investing with your own company, and then you're managing your life accordingly. That would be
you nailed it. And I think the way private equity guys look, we can buy this, make this week, and sell it higher. When you're thinking about your value enhancement strategy for your business, it's the same thing. You're thinking about your company, as you said, like a private equity. What would they do, and why don't I just do it myself and get that premium for me? Right. And then with the wealth planning part, it's through positioning our assets in the right places, we can generate better tax efficiency. We can avoid tax in many ways. We shift peas on a plate, so to speak, and our net return gets higher. So through asset positioning, tax location, asset protection strategy planning, and reinvestment strategy, you can literally just enhance the return of what you're already doing. Like the ROI is huge because you're already doing it, and it's just shifting positioning. But you got to take
it more efficient.
time. Yeah, make it more efficient. You got to take the time to do that, and that's the hard thing. It's not a priority until it's a priority. And
I love it.
yeah.
All right, Ollie. So, is there anything that any important topic or concept that is in the book that you want to make sure that we highlight a little bit?
You know, I appreciate you asking that. There actually isn't a topic in the book, but there's something that relates to this conversation that I want to mention because it's a common theme with business owners. Business owners love cash flow.
Okay, wait, does anybody not like cash flow?
Yeah, and there's more to this. But I get owners that come to me and they go, Ollie, I need an investment that generates cash flow. Like I want to put my money in assets that generate cash flow. And the thing that oftentimes isn't disclosed, knowing the financial world the way that I do, I would argue that most business owners want to have, and the best return possible, would want to have only cash flow to the amount that they need the money to spend each year. And any cash flow above and beyond what they need to spend, they're actually being inefficient by generating too much cash flow. And this is a concept that I explain to owners, but it's so common, especially on a podcast. So the default is I want 5% or 10% cash flow. Well, let's just take a public market stock. And this is the same thing with anything else, but definitely with the public markets. If you pick a high dividend paying stock, and I can find you many, you want a 5% dividend on a stock, sure, we can find a 5% cash flow dividend. But if you don't need that cash flow to spend and your business is already spitting off enough money, the return on high dividend, high cash flowing investments, the total return is not as high as it would be for companies that are reinvesting cash flow for total return. So if you kind of like looked at the market return at say 13% a year in the S&P, what was the rate of return on the dividend stocks in the S&P? You might have 5 times the cash flow, but your total return instead of 13 might only be 8. So because those companies that are reinvesting are reinvesting for growth. And I think it ties to all the concepts we talked about today.
I love it.
Your company, when you're reinvesting back in your company, you're not getting as much cash flow, but your enterprise value could be a lot higher over 5 or 10 years. The same way when you're investing in the market, if you buy stocks because you want cash flow, you're actually doing the total return a disservice. It's better to have cash flow positioned as to what you need or liquidity there and invest for total return. So that's just one concept that comes up often with owners. And the question I ask myself is, should you ever want more cash flow than you need? And aside from just having a little cushion, I would argue no. But I think that
lifestyle creep is a thing, man. I know way more than one person that couldn't sell their business for like tens of millions of dollars because of their lifestyle. Well, because of their lifestyle. Yeah, like, oh, well, I can't sell my company for anything more than $50 million. Well, that's because you have 3 ranches, 15 cars, and I mean, like, it's like, that's only your fault.
Right.
Man, this has been so fun. I'm so happy we finally got to do this. I have 2 final questions for you.
Sure.
The first one is, I love to know what people think of the word intentional, what it means to them. So what is your definition of the word intentional?
Oh man, I love the question. I'll start with in wise. It's sitting down if you can see it on my shirt.
Oh yeah.
Our system. If you notice on the eyes, there's 2 circles. And the 2 circles represent intentionality and integration. That's why there's 2 dots on the eye. So intentionality is a huge deal to me as well. And being intentional is one thing. Intentionality is a state. And to me, what intentionality is a constant state of being where you're thinking about the purpose behind what it is that you want and living in a state of intentionality. You can have intention on 1 or 2 things, but when you're in a state of intentionality, you're constantly thinking about what's the purpose behind this. And for me, it's living in alignment. I have my ideals and my values and the way that I believe I want to live my life. And I think each business owner I work with has theirs, and some values are the same, some are different. But when you're intentional, you're essentially making sure, does the purpose that I really want in life, is that in alignment with what I'm doing? And that's
Oh,
intentionality for me.
that's amazing, man. That is very, very intentional and thought through. I love it.
What about for you? Can I ask that, or is it...
You know why you're doing what you're doing, and you're marching towards a clear state in the future, and your actions are in alignment towards where you're trying to get to. And then you can course correct along the way. It's not going to be easy, but you're like, I know, like, I'm conscious of why I'm doing what I'm doing and how those actions are going to get me closer or further away to my goal.
Awesome.
I've not had anybody reverse that on me, so I appreciate that.
Well, I was really curious to know. I didn't mean to put you on the spot.
No, I put you on the spot. All right, man. Last question is, where do people find you, your book, and the best place to reach you?
Sure. Well, so the book is The Business Owner's Dilemma, and that's just on Amazon, Business Owner's Dilemma by Ali Nasser. And the easiest way to get a hold of me, and because whether there's kind of two paths that a business owner can, actually there's three paths, but there's one, I'll give you one way to do it. One option is reading the book, Business Owner's Dilemma. I think if you loved what we talked about today, you can, get 150 pages of that. The second thing is if you're looking for education and coaching kind of workshops around this type of material, there's Wise Global Network, which is our education coaching company. And then if you're saying, I really want this guidance, I want to work through my position, I want this integrated planning, I want this holistic wealth guidance as a business owner, AltruVista is the name of my boutique wealth advisory firm, where we've got a team-based approach to doing all of this. The easiest way to get a hold of me, regardless of which one of these three paths you want, is just send an email to me and my team. It's just ali@alinasser.com. So ali@alinasser.com. And just email there and tell me what's on your mind. Tell me what you like from the podcast.
Tell me what you want.
Tell me what you want, and whether you want to figure out if our wealth planning, fiduciary services are for you, or you're trying to figure out if you want more education or coaching, or you just have a note on the podcast that interests you, drop me a note. That's the easiest thing. Me or my team will get to you. Just ali@alinasser.com.
Ali, man, you make it even simpler for everybody. So thank you so much for coming on the show, man. I really, really enjoyed it. I'm glad we finally made it work.
I feel completely the same. Since I met you, it's been kindred spirits, and I'm very grateful to be on the show and just to have our friendship and our collaboration. So thank you.
So that was a blast. I really, really appreciate Ali, his perspective, his approach, and just how thoughtful he is, and being able to deliver these concepts in a way that we all can understand and that are relatable and are not self-serving. That's really one of the best things I appreciate about him and his approach. I would highly recommend checking out his book. And again, the main concept I really want to hammer home is that it doesn't really matter. Actually, it doesn't matter at all whether you're solving for annual cash flow or long-time value creation, as long as you're clear that that is your goal, and then you're understanding how your decisions impact your ability to get closer to those financial targets that you've identified. And again, check out the 3 financial targets in the last episode if you have not, which is principle 2 of the intentional growth principles. Otherwise, also a great resource is check out the Intentional Growth Financial Assessment, which is in the show notes or on arcona.io, the website, where it's 22 questions and then you get a score. And then there's a bunch of videos following that on how to actually use your company's financials to see the cash flow and the company as an asset. Thanks everybody for tuning in, and stay tuned for next week, where I have Rob Dubé and Cindy Banshee on the show, where they're clients of ours and they're business owners that have been using these resources and this mindset to view their company as an asset, and then to be able to, they're going to be sharing with us how their decision making has been different and their lives are different after they've been literally looking at their company as an asset and how they've been managing it accordingly. Thanks everybody for tuning in, and I'll see you next week.